So people often come to me and say, hey Peter, is the market efficient? Because if the market's efficient, then you won't be able to make money. However, I will always contest that. My view is that the market is efficient if you choose to measure it that way. And it's very easy to come up with contradictory proofs in any particular market, whether it's betting markets, financial, and so on. However, I thought I'd give you a great example of exactly how you can make money despite the fact that it's seemingly impossible to do so. If you're interested in learning to trade on Betfair, then visit the BetAngel Academy, where you have detailed, structured Betfair trading courses. Or why not visit our website where you can download a free trial of BetAngel Professional, but also visit the forum where you can get detailed images, examples, and downloadable files. And don't forget to subscribe to our YouTube channel and click on the bell icon if you want notification of new videos as they're released. So I'll tell you the backgrounds to this before we sort of get into some of the detail, because it's worth filling out on the background. But when Betfair introduced the premium charge in 2011, suddenly I realized that trading is very efficient. So if you're a true trader, if you're trading properly within the market, then you'll probably have a reasonably high strike rate, certainly a strike rate above your average punter that's taking place on the exchange. And that's because what you're actually doing when you're trading is you're not putting your whole stake into the market. You're effectively risking part of that stake and you're getting a return on part of that total stake. So you may win a bit, you may lose a bit, but basically it's a very efficient way of extracting money from the market. Let's face it, that is effectively what good trading is. If you're traditionally punting, however, though, you'll have big wins and big losses and you'll pay quite a lot of commission on it. If you want to understand some of the detail behind that, I have done videos on it. I may put some in the description, or if you're interested, tell me on the comments and I'll link you to those videos which describe how that interaction takes place. I'm not going to do it on this video. But basically, when you're actively trading and you trade in the manner in which I do, it can be pretty efficient. You don't tend to get large losses. You just tend to get a sort of a stream of bumpy but regular profits, and you get gains and losses and so on, but they tend to be quite small and you tend to get an equity curve that looks quite nice. So the problem is when the premium charge came in, I was basically too efficient. And because there were several tiers of it, it made sense to suddenly become a little bit more inefficient. I know that sounds a bit weird, but you'll have to watch that video to understand specifically what's going on there. But the practical upshot of all of that was that I needed to generate more commission one way or another. So I knew that the market was efficient. And everything that I was looking at sort of pointed to the fact that the market was efficient. So I thought, well, if I just go out and do a number of bets within the market that are in roughly equal proportion to the chance of them occurring, then over the long term, I should break even. So I went off and started doing all sorts of bets. And the funny thing is, that I'll just interject here and throw something at you. If you go into a market and you bet to a market with bad money management and bad risk management, then you'll probably still lose money anyway. Because what you have to do is you have to match the activity that you have in the market to the long-term expectancy of the event itself. So what I'm basically saying is you bet to the probability of that event occurring is effectively what you do. And then what will happen is you'll break even. If you get your staking wrong, it's quite perfectly possible that you could bet into an efficient market and still lose money because you're taking too much risk in some markets and too little in the others, and the two won't balance out. It just turns out that the time that you're in the market, it's slightly favorable to one end of the market or the other, and that could work for or against you. So you may think that you're a genius or a fool, but in fact, it's just your staking and your risk management that's completely wrong. So I approached the market from attempting just to balance out all of the activity that I had within the market. And to do that, I was taking positions in the market, sort of at random, not completely, but sort of at random, and expecting it to average out over the long time, which is more or less what it did. And I say more or less because I started to notice some regular repeating patterns. So I was putting some positions into the market and they seemed to keep making money. And I was thinking, that's just normal variance. And therefore I can just ignore that because that's, while it's above the line at the moment, it will eventually regress back to the mean. And I just won't make money over the long term. But the longer I kept on doing it, the more I realized I was onto something. So it was quite bizarre because I'd pretty much sort of discounted active betting in the market because trading was much more efficient. But because premium charge gave me an incentive to pay more commission, through betting, I ended up, digging into that area. I basically ignored it because trading was just so much better. And because the amount of commission you have to pay on a bet is higher in proportion than that which you do when you're trading, which is why you should trade rather than bet, I just ignored it. But yeah, two key factors: introduction of the premium charge, but also the markets were getting more efficient over time. The overround was shrinking. So I thought, well, this is going to be easy. But yeah, it confused me that I seemed to be making money, and I felt that it was going to regress, and it just simply didn't. So I just thought, well, that's weird. How could that possibly happen? And what it turned out was that because I was actively trading these markets, I was actively finding points within these markets, depending upon what strategy I was using, that was allowing me to profit. So of course, instinctively, you then start looking for, to refine those opportunities. You're sort of thinking, well, if by accident I've managed to make it slightly profitable, then if I put a bit of energy and effort into it, then I can make it really profitable. So, let's head down that route and see what I can do. So yeah, I originally started by going into horse racing and other sports and actively Dutching those particular runners. And the reason that I did that is because it reduces the variability fairly dramatically. If you're backing favourites within a market, then it could be that the favourites are extremely positive one month and extremely negative the next, or there could be variations within that. And so your P&L diverges massively up or down over a period of time. So by Dutching, I figured out that in fact, that would reduce that variability and generate reasonable amounts of commission. But I actually started making money doing that. And I'm thinking, well, that's weird. So I then started looking deeper and deeper and trying to refine that. And then I eventually ended up with 3 entirely new strategies, all of which generated reasonable amounts of commission, but they're also profitable as well. So it's like, well, hey, I couldn't believe my luck. Although luck is where opportunity meets ability. That's always my firm belief. You need a little bit of luck. Things need to happen, like, me switching and having a look at this market as a particular problem. So there was my bit of luck. But of course, it wasn't something that I just did at random. There was methodology behind everything that I did. So, I ended up with a backing strategy, a laying strategy, and a Dutching strategy, which would basically all 3 of them. I could find markets where the opportunity was good enough to be able to perform those actions. And therein lies a hint as to where we're heading on this particular video. Because, fairly often what I'll do is sort of, drop notes on social media, sort of say, oh, this is too short, this is too big, and I'll make those sort of general comments. And I always feel like I'm onto a loser because you could make a string of those and, make fantastically good judgments. But if you get one wrong, then everybody comes out and laughs at you, basically. But I've got a thick skin. I've been doing this for a long amount of time and I don't care. But it is funny how you see that come through a lot of the time within the market. But we had a day not so long ago. I'm trying to remember if it was a Friday or a Saturday. Can't quite remember off the top of my head. But what actually happened, we had a series of large back orders go into the market. So I could tell from a trading perspective that there was something going on in the market and somebody was basically backing a favourite to win. And when it didn't win, they were just returning with a vengeance. And the interesting thing is that threw up all sorts of opportunities. The primary one really was a trading opportunity because it was so easy to make money on those days. All you needed to do was to be on the back side. And if you were backing and then laying off at post time, you would have made a small fortune. And basically, you look at the charts on that day and it was like, huge backing, huge backing, huge backing, huge backing. You could have been an idiot on that particular day and you would have made money if your strategy was to look for a favourite where the price was going to come in. It was going to steam or the price was just going to move in your direction. So when things like that happen, I'll very often put up observational notes. I'll sort of say, oh, this is interesting. If you would have, backed and traded out at post time with £100, you would have earned this amount of money. Now, when I do those things, these are what I call observational tweets. So I'm not sort of saying, and that's what you should do tomorrow and for the rest of the year. It's basically just sort of saying, this was interesting. And it sort of, correlates the pattern of activity in the market with a number. And, if you're smart, then you'll have a look at all of that and, you'll begin to realize what happened, why it happened, how it happened, the way that the market's behaved. And therefore, the next time that it happens, you'll be able to spot it and jump on that. So when I do these things, it's because they just stick out. They're not normal days. Something interesting happened and I throw them out there for observation. I'm not saying this is a strategy you endlessly pursue, because if you endlessly pursue a strategy, you end up with this situation where if you do something generically, you just get generic results. That's not the key to being able to make money. But when I posted up this message, somebody came back to me and said, oh, do you think that laying the favourites on this occasion would have worked? And I sort of went back to them and said, well, probably, I'll check it. But it wouldn't surprise me if the favourites had been overbacked on this particular day in this sequence of events. So yeah, on seeing that reply, somebody else came forward and basically said, oh, according to this particular app, in fact, you would have made money by backing the favourites on this particular occasion. So, immediately there was a bit of a contradiction going on there. And you sort of, feel inevitably that these sort of things are going to happen because everybody wants to be right. But the funny thing about this on this particular occasion is it was measured over a 30-day period. And they were basically saying, if you'd have backed favourites over this 30-day period, in fact, it would have been positive. It wouldn't have been negative on this particular occasion, But the funny thing is, the lay strategy that I was running in the market over the same 30-day period, what I'll do is I'll actually put up a graphic of it over that 30-day period. I'll put up the equity curve. And basically what the equity curve is doing is measuring the return that this strategy got over that particular period. But if you look at my lay strategy, which is focused on shorter priced favourites, you can see that it did particularly well over this particular period. So, you suddenly immediately have this contradiction. You've got, and I'm not picking on this particular tweet for any reason or to put doubt on the numbers that came out. Don't get me wrong there, because they're probably accurate. I haven't checked them, but I guess that they are accurate. But basically, I was making money by doing the complete opposite of what the market allegedly had done. So my lay strategy is focused on favourites. Why? Because if I can get a lay in at a very short price, or a decent short price, then the liability is low, but the returns are relatively high. So the strategy itself relies upon probably losing a fair number, but getting the odd positive, and you sort of see it jump up over a period of time. But the stats from the software was basically saying if you'd backed everything at Betfair SP, then you would have made 800 quid. But the fact is, I actually made a lot of money by laying exactly the same runners. And you're sort of thinking, well, how's that possible? But it shows in beautiful contrast how the market can show you one thing, but how you can achieve completely the opposite. Like, this isn't even talking about efficiency. This is talking about polar opposites in terms of strategies over a set period of time. But of course, the trick that I'm using here is I'm not looking at every single favourite. I'm just picking off the ones that I think are bad value. I got it off to such a T that all of those three strategies that I mentioned just work automatically in the background for me. I don't have to do a thing. BetAngel will sit there, look at the market, make a judgment on it, and then place the bet if it thinks it's appropriate. So you can tell that all of the information that I need to do that and to be profitable is actually contained already within BetAngel. But what I'm doing is I'm not doing it on every single runner. It's just waiting for the opportunity. Automation can sit there, scan all of the markets day and night if it so wishes to do so, although this is a strategy that's predominantly on UK racing. And it just basically waits for the opportunity, looks for a certain type of criteria, and then it throws a bet into the market. But look at the difference between the two. On one hand, you've got somebody saying, if you bet with £100 on the favourites, you get 800. And then on the other side, I'm saying, but I was laying those exact favourites, not all of them, and running away with a really, really good month. In fact, I think it's probably the best month that it's had over the course of the year. So it all boils down to how you look at the market. If you take the average price of the favourite and you look at how often it wins, generally that's sort of correct, but it doesn't mean that all of those are correct. It could mean that in one market we have a heads and in one market we have a tails, and effectively end up 50-50. So the market could be wildly off in one direction in one race and wildly off in the other. But if you average them out and you look at them overall, the market looks absolutely perfect. But also, you know, even if there is a predominant trend within the market in one particular direction, you're under no obligation to have to make a judgment on every single thing in front of you. You can sit there and wait for the market to make an error. And the fact is, one of the things that I've noticed on horse racing is there's this wonderful level of uncertainty on it. Nobody knows absolutely for sure how the horse is going to run, how it's going to behave, how it will adjust. Is it stepping up and stepping down? Is it a 2-year-old that's coming out for the first time? Is it a progressor? Is it a 3-year-old that hasn't raced this season but allegedly seems to have done all right on the gallops? There are all these uncertainties thrown into the mix on racing. And for me, you know, when you get massive amounts of uncertainty, I think that that's where the greatest opportunity is. But the problem that you'll often face is you'll look an idiot when you get it wrong. And also the pressure on you to conform and to not be an outsider is actually very strong. So you have to have this will about you and about the way that you're doing it, to be ready to accept losses and ready to accept that you're going to be wrong frequently, but to make money over the long term. And that in itself as a skill, it seems to be something that people find very hard to do. People have to be right, they have to win. But in fact, I think very often profitable betting and trading is a case of, you know, taking opportunities when you see them, not taking all of the opportunities if you want to, but also accepting that you're going to have a loss, and that over the long term, you're just trying to balance those two things out to get profitable. But yeah, you know, the market's efficient if you choose to measure it that way. But if you actually look at it a little bit deeper, then it quite clearly is not efficient. If you look at the length of time that I've been going, what I've been doing, I think I'm the absolute perfect epitome of somebody that's able to profit in a market that's allegedly completely efficient. But the fact is, whenever I do this and look at it, you know, I see inefficiencies all over the place, and I see that people are looking at the market incorrectly and in the wrong manner consistently. And in fact, there are simple solutions to what appears to be quite complicated problems. But the thing is, I also realize that people will just never go up trying to prove that it's efficient or that there's something funny going on or whatever. But the fact is, my approach has been sort of quite common sense. It's been sort of stats based. And I've been looking at all of the same things that everybody else is looking at, but with a different view on it. And also, I'm not suffering from the sort of psychology that a lot of people have about the way that they manage their money or deploy risk or the risk of failure. I'm quite happy to accept failure, knowing that further along the line, everything is going to balance out. But it's a simple thing to do, but it's actually quite tough. It's simple but not easy, I think, is probably the word that I'm looking for here. So yeah, the markets are efficient, but inefficient at exactly the same time.